Okay, Chapter 16, Video 2, Cash Flow Statements. They're just giving you an example of some transactions involving cash and non-cash aspects, and then these are the things that you would have to adjust going forward to get your cash flow statement. An example of the indirect method. Again, you're starting from the income statement, not the balance sheet on the indirect. So you start with net income, and then you look at changes in the non-cash current assets and current liabilities. Was there changes in your accounts receivable or accounts payable? Was there changes in your inventory? And then you adjust accordingly. And then you have to add back some non-cash expenses, because you have to add that back to the net income, because depreciation and amortization was a non-cash but tax deductible expense. But so because it's the cash flow statement, you have to now add that back in. Any losses and gains on transactions, and that generates your operating activity cash flow component. And again, changes in your current assets and current liabilities. Sometimes you're going to subtract it, sometimes you're going to add it. It's a little bit more confusing, and that's why a lot of times CFOs will sort of keep a cheat sheet spreadsheet that they develop that goes from step 1, step 2, step 3, and they just follow that order. Again, they're just breaking out the operating activities, increase, decrease of a variety of categories on your balance sheet. Again, greater explanation of each of those from the prior one going forward. And then here's your summary. I don't think I need to explain it because it just follows from the prior period. Again, it takes a little bit of time, and just look and understand that indirect versus direct method here. Okay, cash flows from investing. Again, identify changes in investing related accounts, explain these, and then report their cash flow. So you're doing the same thing like you did in the operation now. You're just taking it down to the investing section of the cash flow statement. And again, there's changes here. Plan assets, like for instance, there was a $40,000 increase. Obviously, they bought something here. If they accumulated depreciation, you're going to add that added $12,000 back. So this is how and you need to slow it down and think about every step. Was this taking away cash, or was it adding cash? Don't try to memorize it. Think it through. And again, it's just going to give you some examples here. That's done through reading. And here you go. And they're now providing your difference here. The $12,000 here, the plan assets, the depreciation. Same thing now, you can do that same step in the financing section. And again, this is where the companies maybe sold stock, bought back stock, or long-term debt. And here you can see the notes payable are changing, long-term, not current. This is the long-term in the financing section. And the changes maybe in the equity. Again, retained earnings have increased from net income. And again, some more examples from this. Let's follow slowly here. And then you're going to get so now you have your 3 areas, from your operations, investing, and now your cash flows from the financing statement. And then your summary of net increase or decrease in cash balance at the prior period, and now your ending. And then it will end after this with some footnote of some non-cash transactions. I'm not going to go into the global view. Again, I believe this is more of an intermediate accounting position. Most managers, again, stress the importance of understanding and predicting cash flows for business decisions. Absolutely. Cash is most important. And in managerial accounting, we will do budgets. And the last budget is the cash budget. And you have to do all the other budgets first to get to cash. Again, you have to manage your cash in order to pay your bills in a timely manner. They'll have a variety of ratios. I'm not going to expect you to memorize this stuff. I'm not going to test this in this chapter. We're going to get into more ratios in the next chapter, chapter 17. But understand there's a gazillion different ratios, and analysts and stock and investors do this because they have spreadsheets that can do this automatically. But this is not something you need to memorize. Again, as I said earlier, they will use spreadsheets to calculate this. CFOs and accountants and so forth, because it can get quite complex and mind-numbing on there. So it's easier to visually see this and track it all through a spreadsheet rather than just each individual transaction. You start seeing the whole thing here. Again, I'm not going to go into this. Again, you're just tracking all the changes in cash, where cash is coming in and where cash is going out. Here's an example of the direct method. Receipts from rent, again, all the different accounts, and is it increasing or decreasing? How's that affecting cash? Line item by line item. That's the end of chapter 16. We'll leave it there, and now we're going to go into chapter 17 after this, and then there will be a test after those 4 chapters, and then there will be a project. Basically a financial analysis of a publicly traded company.